Hey everyone, it's annual review time for our portfolio. For the past 12 months, we've been buying stocks, and we purchase one stock every month at $400 a month based on a whole bunch of metrics we set in past videos, and we figured it would be time for you to see how did we do? How
It's
did it
our
work out?
1-year anniversary review of the stocks that we've purchased.
This portfolio is important, and it may not seem like it's that much right now, but there's a foundational aspect here that we want people to understand. So we're going to show you the portfolio. We're going to show you everything that goes into the portfolio, how that performance was, what we did with it, and the interesting aspects around what it actually means. Here's the portfolio. This is what we have. You're going to notice something. If you've been following along in the stock market for the past year, you're going to see the Standards & Poor yield. You're going to look at the Dow Jones Industrial Average, and you're going to go look at the S&P 500 index. The S&P 500 and the SPY funds have dropped around 10.8% last year. The Dow Jones has dropped somewhere around 4.5% to 5% in the last year too. Our portfolio, excluding dividends, which are somewhere around 4.5% to 5%, has gone up 6% in the past year. That's a 16.5% swing, people. When you're looking at, well, what stocks do you pick? What stocks do you buy every month? Well, there's actually a method to that madness, but I want people to understand that in the last year, we've done better than the S&P, and we've actually outperformed that market by quite a large margin.
And I don't know about you, but I call that so-called beating the market.
Yeah, we had somebody comments like, well, you guys aren't really beating the market. Well, we are. Here's the 16%. Here's the definition of that, in case you are still watching.
Yeah, you only have to be 1% over the S&P to be beating, quote unquote, beating the market. And we're doing that by quite a bit.
Can we do that every year? Well,
no guarantee.
No guarantees. Right now we're in a kind of an extraordinary period with inflation, the Fed raising rates, the recession indicators, the housing market bubble, the asset bubble, all the things that are going into what looks to be like a pretty nasty recession over the past year. In fact, the market as a whole has done relatively bad. There's been a lot going on. The timing of this with what our portfolio did and how we started was kind of fortuitous for our portfolio. Our personal portfolios, if you've had stocks for many years, you've watched some of them drop a little bit.
Right.
I've gained enough on my personal portfolio where it doesn't make any difference. If I sold it even today, it would still make me a lot of money, but we're not buying for the capital gains alone.
Right.
We're buying for value investing. There's a method to this, and the dividend income that it generates. You want passive income. You want that money to work for you. It's not necessarily as good if you have to pay attention to it all the time, and we're busy people. We don't have the time to do that. In this portfolio, when you're looking at the strategy here, we're more of contrarian, more of a value investor, and more of a dividend income kind of people. But be careful when you look for dividend income stocks. There's a couple on our list. Rio Tinto, comment below if we don't know how to say it. Is it Rio or is it Rio?
Or doesn't matter.
Doesn't matter. But those two stocks, Rio and Devon Energy, they pay a really big dividend. And we've talked about that in past videos. There's a playlist. We'll probably post that playlist as we talk about these multiple times because we don't want to get into every single stock and why we bought the stocks. We did that. We've got past videos where you can see why we picked what we did.
Yep.
And there's plenty of that for you to watch.
Put the playlist up here so you could watch it. Watch them all. Just put them on repeat and just go through the entire 12 stocks.
We don't always get engaged. What we do, we milk it for everything it's worth. So the portfolio itself, like I said, it's done well, but we're not investing solely for capital gains. We're investing to protect our capital, which we did that. We did quite well at that. We're investing for the income.
How did we do for our 6%?
Now, I want to talk about the risky ones for Devon and RIO. The bigger the dividend comes in from a stock, the more risky typically the stock is. We've seen people talk up JEPI, JEPI, ZIM, PBR, a lot of the ones that have a lot of controversy surrounding them. And if you look at what's happened to those stocks in the past year, they've gone down quite a bit. Keep that in mind that when a company pays a big dividend, they have to pay that somewhere out of their operations. Free cash flow, operational income, the assets they have, and new contracts, maybe something from their business. So the bigger that is, the less of a chance they have to grow their business. REITs, REITs for real estate, they're different. We're going to talk about that later when eventually we buy one. We're not yet, we're getting there. You'll notice that our worst performer in our list as it relates to the dividend is Devon Energy. Now, TD Ameritrade does not show the dividend properly. For some reason, every time we pull it up, it's different.
It's always 1%.
Yeah, and they pay a lot more than that.
Yeah.
But so if they're paying around 8%, I think when we bought it, they were paying more, and we said no, it's a 7 or 8% dividend.
And if you go back to the past videos where we purchased Devon or we talked about our portfolio, I always go back and post and fix the percent so that it's correct.
Yeah,
and the
fix
payout.
that, please. TD Ameritrade, please.
If you're watching this, why would they be watching our videos? But if you work for TD Ameritrade, go tell somebody.
Yes, please. Devon is a high dividend payer, but they're also our worst performer. And I want to touch on that just briefly because RIO is in that list. Most of the other ones aren't. They're pretty safe. We know they're relatively blue chip companies. There's a timing mechanism behind that, and you'll see that come out in the next few months. But they pay big dividend. They dropped almost 20%, but they also paid half of that and maybe just under half of that in a dividend. So
Right.
there's still a loss there. Our best performer comes at somewhat of a surprise. Our best performer used to be, throughout the year, used to be Devon.
Yep.
And then it was RIO. And then, I mean, it's been all over the place. So right now it's Intel Corporation. Intel Corporation in one of our, I think it was 2 months ago.
Yeah.
2 months ago, we bought Intel. And they cut their dividend by 2/3. And
Like
everybody piled in.
65%. Yeah.
Everybody piled in. So if you're talking best performer to worst performer, Devon had a net loss of 10% roughly, somewhere around there. And Intel, our best performer, currently, now these ebb and flow, and we're going to talk about that. It's very interesting how we take what is happening there to what we're investing in the future, because there's a method to this. But Intel, they pay a 1.7% dividend.
Something like that, yeah.
Yeah, so they pay that. They've gone up somewhere around 20%, so 22% for Intel net gain. There's a 12% swing there. Big dividends don't necessarily mean good investment.
Right.
Usually it's the opposite. As it relates to the foundation in our portfolio and what happens over 20 years, you need to be very closely paying attention to the health of the company that you're investing in. If you don't do that, what's going to happen is you're going to buy Zim at 80 and it's going to go down to 20, and then they're going to declare one final dividend, and we're going to talk about that in a future video, and you've lost 3/4 of your money.
Right. And now you're dollar cost averaging month after month to try and keep up with whatever losses you've gotten, and hopefully you get your cost basis down so that when it hopefully comes back up, you'll make more money off that, and maybe they'll reinstate their dividend because now they're making money. But that's a big risk, and that's one of the reasons why we didn't go for Zim. There might be a time where we say, yeah, Zim's $8 and it's a great buy, and now's the time to get in, but now's not the time, and this isn't that video.
There's some book value metrics we're going to cover in that video that'll tell you when it's a good time to buy that. But on that same very note, the worst performers that we have in this list are Devon Energy, 3M Corporation, which I feel like I jumped the gun a little bit, and then Comerica Bank, which we have a tendency to do that. So thankfully, by the time we talk about the stock, purchase the stock, and then finally get the video out to everybody here, usually it's a better time to buy anyway. So the three worst performers, we're going to be looking at those next month, and we're going to look at them financially. So we're going to see how they're doing financially, and we're going to try to pull the most recent quarterly reports from them to find out which one financially looks the best. And then what we're going to do is we're going to compare that against the other businesses in that sector. So if there's another company that looks good, or are we going to add some more to Devon Energy, or we're going to buy something else?
Right.
Or are we going to do the same thing with 3M or Comerica, whichever one looks the best? And in that way, we're taking advantage of some very important factors with regards to dividends. The dividend payout ratio, the dividend yield, and the cost basis for that dividend play a very important factor. What's a factor?
Implications.
Like I said, no script. We take that into account for the cost basis for that dividend when we buy that. And over a period of a long time, couple of years, not weeks, not months, don't buy stock and check it next week to see what it's doing. That's day trading. Don't do that. That's dangerous. There's some stats on day trading that you should probably watch.
Don't get emotionally involved in your stocks.
Yes, and buying a stock is a lot like you getting a construction loan and building a house. It takes time for them to build that house. Don't just show up the next day and wonder why they haven't had the foundation and the curtains up in the house when you just gave them the money 2 weeks ago. All of these stocks are done within the realm of years of investing, not days,
Right.
not months. These are years. We're going to take the best performer financially from that list, and in the course of years, We're going to figure out which one looks like a good buy. We're going to take all the dividends we've been getting from all the other stocks and our monthly $400, we're going to pour it into that one stock. And we're going to do that every month. This is the method to the madness. It sometimes changes. It's a little nebulous depending upon what's happening with market conditions, but there's kind of a gel that we set behind how we do this. And that, folks, is the foundation.
And that's why we diversified our portfolio the way we did. So for a couple of reasons. One, and when the market ebbs and flows, stocks tend to either go up or down depending on what industry they are, so that when some of our industries go up, others go down, it evens out that curve so that we're not either big losers or big winners.
Right. This is buying stocks based on their value relative to their earnings. This is how you value invest for income. What we're doing is not exciting. It's not even sensational. It's not very clickbaity. In fact, some might even say it's kind of nerdy, which, I don't know, is that good?
But isn't that what you want? Don't you want the nerdy viewpoint of your stocks that you're going to put your hard-earned money into to make more money so that you can retire early and do the things that you want to do when you're not so old that you can't even do it anymore? That's what I want.
One of the things that helped us start this channel was because we wanted to show people how we did it, how to educate people, how to build wealth over time. And oftentimes that's not exciting. It's not even very sensational. And like I said a few seconds ago, it's not even clickbaity, but it works. You build a foundation, you work on that foundation, you stay consistent with what you're doing over a period of time, and you become wealthy through that over the course of that time that you're doing the investments. So this is called building wealth. Building wealth is different than being educated, being rich, or anything that you would see in a lot of the other videos. Building wealth is something that you do over the period of a long time. You don't just instantly win the lottery and all of a sudden you have lots of money. So we have a portfolio that we did that foundation for, we built that foundation for, and we want you to see that. We want you to see the stocks that we purchased in the portfolio, and more importantly, we want you to understand what that actually means.
We're trying to put our hard-earned cash on the line for you so you could see it over time, how it all works. Because a lot of people tell you, okay, this is the dividend snowball, and this is the effect, and this is how it works. You do this, but you could actually see the money we put into it and how it's affecting our portfolio. And that's what this video is about, to show you what we've done over the last year and how the snowball effect is starting to take effect.
It's like nerdy finance show and tell.
Yay.
And there was much rejoicing.
When you look at this portfolio, whether you're starting with $40 a month or $4,000 a month, this is a very important foundation. This is the most important part right now. The non-sensational, non-essential part, but that brings us to our closing points. Wealth is built with consistently good habits done over the period of a long set of time. Not overnight. This isn't something that you're going to be able to get rich on tomorrow, but it does work. Just be careful when you start getting those dividends that you don't start buying a whole bunch of fancy stuff like I do. You can buy some things, but just don't dump a lot of it in there. But as you see this portfolio build, you're going to start noticing that trend, and you're going to start seeing that snowball we showed in the spreadsheet earlier in the video, how it takes effect. And we hope you found value in that. We hope you find value in watching this. Because that's the whole reason why we're doing this. We're trying to help people understand finance and trying to help them become wealthy financially. It just takes time. So again, thank you for clicking on the video. Thank you for watching this. And if you got to the end of this, OMG, or Tom won't shut up, or what was it you said? That we did 2 takes on this.
We'll just do OMG in the comments.
OMG. Okay, OMG.
Yep. And people have asked how they can support us, and since we don't have Patreon or anything like that, the best way is to subscribe and watch and give it to your friends so they subscribe or watch.
Right. We're doing relatively okay. If you're new to investing, we'll set up a Patreon. We'll do that eventually, but we don't need that. Our intention is to help you. So
we'll if we do set up a Patreon, we'll do things like put the spreadsheets that we use in there so that you could see them and use them too for your own purposes. And we'll start adding little templates and things that we use into the Patreon, so anybody who pays into that has a little present.
We've also thought about giving some people some of the dividends based on if they recommend a stock and it ends up to the top of our list. We don't know how that works. We don't know the restrictions around YouTube that well yet. So we'll figure that out and we'll bring that to you at some point too. So thank you for watching. Hopefully you find some value in this. Next video, we're going to do month 13, our stock purchase for April. And we're going to coincide that with a follow-up on our video for Zim. So please look for that, and hopefully you stick around for everything we got to show over the next months, because it's going to get good soon.
Again, thank you for watching, and as always, happy investing.